So another part of budgeting involves preparing your budgeted income statements, and we're going to start off here with looking, of course, starting with our sales revenue. So here your sales in April are, you were told that's 50,000 units, and they're expecting a 10% increase for May. So you just take your 50,000, increase it by 10%, 55,000. In June, you're expecting an increase of 3%. So it's not 3% of the 50,000, it's 3% of the 55. So it's 3% increase of the previous month. So that's where the numbers are coming from for the sales for May and June. So when you're looking at your cost of goods sold, we'll just go down here at the bottom and see how that's calculated. So your cost of goods sold, you are given your beginning inventory. That figure is given to you in the problem, the 14,000. That comes from section B in the problem, so that's where the 14 is coming from. Our purchases, we're told that our purchases are equal to 50% of the sale. So that's what it's costing you to purchase your inputs for that. So 50% of 55,000, 27,500, and similarly 50% of your 56,000 is 28,325. So your total goods, the cost of your goods available for sale, so what you started with plus what you purchased during the period is 41,500. Then your ending inventory is comprised of two components. It's comprised of $9,000 plus 3% of the budgeted sales for the following month. So when we're looking at this number here, so it's 9,000 plus you have your budgeted sales for the next quarter. So we're looking at 50. So in the month of May, we are looking at your budgeted sales for the month of June. So that's 56,650 times 3%. So so that's equal to your 25,995. So that's where this number is coming from. So that's your ending inventory. So it's 9,000 plus 3% of the following month's sales. So your cost of goods sold is your goods available for sale less what you had in ending inventory. So that means the difference is what you must have sold, 15,505. So that's how you determine how much you sold. You figure out how much you had at the beginning, how much you purchased, then subtract your ending. So it's beginning inventory plus your purchases during the year less your ending inventory. And that's equal to your cost of goods sold for the year. And you're doing the same calculation, of course, for the month of June. And in terms of looking at your, so when you go back up, so this is your cost of goods sold, is your 15,505. So you're going to bring that figure up here. So this is where your cost of goods sold, that's how it's calculated. So sales less cost of goods sold is equal to gross profit. Then the next thing we want to do is, of course, deduct our operating expenses. So for the month of May, we're told that your salaries and commissions is comprised of two components, your fixed and your variable. So you have 4,000 plus 10% of sales. So your sales is 55,000 times 10% is 5,500. 4,000 plus 5,500 equals 9,500. So that's where that one came from. Rent expense, you're given that, and you're given depreciation and insurance. So no calculations required there, you just take the information and put it in. Adding up all those, it comes to $13,300. So you're subtracting that from your gross profit to come up with operating income. Then here we're given an income tax rate of 20%, so deduct 20% for income tax, so 20% times your 26,195, 5239 will give you 20956, and you follow the exact same calculation for the month of June. And I won't repeat all of that here because if you followed along for the month of May, you do the same thing for the month of June. So that concludes problem 9-62.